Hey, so folks, today we're here with Steve Tucker from Valuit. Hey, Steve, how you doing?
Good, mate. And yourself?
Good, thanks. And my name's David House, and I'm here from the Property Factory to interview Steve today. So I've been working with Steve Tucker since 1999 when I bought my first investment property, which is officially last century. And I've watched Steve build the Valuit business in the early 2000s into the sort of solely focused market leader around depreciation particularly for residential property, although this evolved into commercial property as well in terms of Steve's business. And so today I thought I'd have a chat to Steve and just to really talk through some of the misnomers and some of the changes that have occurred with depreciation over the last decade and a half, and so that there's real clarity around where depreciation plays a part with existing properties and with new properties, why it's sort of an extremely important part of the financial mix for investors. And then we'll jump into a case study with 350 Colombo Street. We'll look at the property investment analysis, and I'll get Steve to explain in layman's terms why, if it's a positive cash flow property, it can be negatively geared after tax once we apply depreciation, which is a non-cash expense that makes a difference to the profitability of the property. So Steve, take me back to how you got started in business, where Valuit is today, and then what's changed and evolved over the years from a depreciation point of view for investors.
Brilliant. How long have we got? Look, there's been so many changes. I started Valuit back in December 1998. And so, you purchasing your first property in 99, you were one of my early clients. And, at the time, property investment was really just sort of starting to take off again. It goes through cycles and waves. And there was a group of professionals. I was living in Auckland at the time. There was a group of professionals that were all sort of starting out, had all started in business. I was actually an employee at the time. And the accountant said, "Hey, Steve, you need to set up on your own. I'll provide you work from day one." And that's where Valuit came from. So December 98, I set up, and really my focus, I'm actually a plant and machinery valuer by trade. So traditionally I was going into engineering businesses and restaurants and dairy factories and valuing all the plants and equipment. And I'd started to specialise in this area of depreciation and tax work. So pretty quickly within Valuit, we became purely depreciation based. And I haven't valued a piece of plant and equipment in a number of years. So, over the last 20 years, it's been predominantly depreciation work. And the reason that I do it as a plant and machinery valuer is our training is very different to a land and buildings valuer. So a land and buildings valuer that values your house for mortgage or for finance, their style of valuation is very different. And traditionally it became plant and machinery valuers that were doing depreciation work because we were working with IRD around the formation of the depreciation schedule when IRD formed that. So it sort of became our area of expertise. Other parts of the world, for instance, Australia, it's quantity surveyors that do it. And we operate in a very similar way to quantity surveyors. So for one, we're very different to land and building valuers. We got a different style or a different type of valuation. So that's the first thing, is don't get confused. There are a few land and building valuers out there that do a little bit of depreciation work, but it's just so different to what they do on a daily basis. They don't have the systems and the processes, and yes, it can save you a little bit of money, but often the benefits aren't perhaps as great as what they are by getting someone that really knows what they're doing. So 1998 we set up and really jumped into it. Property investment was taking off. My business grew from just me in the first year, and I needed to look at ways of growing the business. Plant and machinery valuers are few and far between. I think back then there was about 40 of us around the country. Most of them were all senior than me, would never have worked for me. I was just a little upstart. So I looked at systems and processes and technology, and spent an incredible amount of money and time on building software. And really what that software did was it allowed me to create an incredible level of consistency across what we do and what we produce. And obviously when we're working with IRD, consistency is the key. So whether it's myself looking at a property or one of my team looking at a property, whether it's Christchurch, Auckland, Hawke's Bay, we've got a level of consistency across the figures that we produce. So that was sort of my start into business, and where we then started to grow into the market leader, because the software allowed me to have people throughout the country doing this type of work. Our guys do cover fairly large regions because this is what we do. It's very specialised. So our guys travel a lot. So for instance, we've got a guy on the South Island and he covers the whole of the South Island. There's generally no rush in what we do. So we've generally got time up our sleeve, before doing inspections and that sort of thing. So,
you mind if I just ask you one question, Steve?
Yeah, go for it.
I've never asked you this, but a lot of kids at school want to be airline pilot, a firefighter, a policeman.
Airline pilots, I'm not sure right now.
What makes you say, I want to be a plant and machinery valuer? Just as an aside, how did you decide to do that? One of 40 in New Zealand.
I didn't. Look, I actually wanted to be a photographer. I was passionate about photography. I'd left school halfway through 7th form back then because I didn't know what I wanted to do. I went and worked for an insurance company. I'd like to say I hated every minute of it, perhaps not every minute, but most of it. And it was really just a stopgap just to try and work out what I wanted to do. I applied for a photography school in Wellington, missed out. Apparently that was standard. You always missed out your first year. And my mother saw a job going at a company that she knew. She was actually a lawyer, or worked for a law firm doing property transactions. And she said, why don't you go and, train as a plant machinery valuer? There was no set qualification or formal qualification at the time. It was like an apprenticeship. So I went and worked for that company, and I guess the rest is history in that sense. Okay. Well, I never elected to do it. It was just something I fell into, and I've done all right at it.
Done pretty well.
But I've sort of morphed now. My passion now is really around business rather than plant and machinery valuation.
Yeah.
So built the business up, and then we went through early 2000. So really early on in the growth period of the business, IRD started to make some murmurings around wanting to make changes, and really where those changes came from was there was people sitting in IRD offices that didn't really understand the full depreciation regime, and they looked at it and said, well, you've got a rental property, you can't claim depreciation on that. And what they actually missed was they actually missed the reading of the depreciation schedule and how you use it. And it's broken up into categories and all sorts of things, and at the end of the day, if you've got an asset that's in your business or in your investment property, you can use it if it's used in a similar way to other industries and rah.
Yeah.
So it started off as a sort of misunderstanding, or someone really in IRD not really knowing what they're talking about, and it just grew and escalated and escalated and escalated to the point that it took 10 years for IRD to finally issue some answers. So we had 10 years from 2000 to 2010 of massive confusion around what you could do, what you couldn't do, what could be claimed, what couldn't be claimed. And in 2010, we finally got some clarity, and they issued two things, really. There was two levels of change. And the first change was specifically to residential investment property. And that change was they created new rules, and they said that for residential investment property, there's certain things that form part of the building structure, and therefore you can't depreciate them separately. You can still do that on commercial property. So things like the idea behind depreciation is that things wear out over time, and they wear out they have a different lifespan. So if you think about the building structure, it lasts, a while, but things like carpets need to be replaced, they wear out. So they all have a different lifespan, and therefore a different depreciation rate. So what they said was, in residential property, things like electrical wiring form part of the building structure, therefore you depreciate them as part of the building structure. Things like the kitchen cabinets form part of the building structure, therefore you claim them as part of the building structure. So it really makes no sense, because look, let's face it, kitchen cabinets, for instance, don't last as long as the house itself, and you do have to maintain them at a greater level and replace them and all those sorts of things. But they came up with this ruling, so that's cool, we went with that. The next change really was, they then said that they were going to remove building depreciation on all commercial property and all residential property, other than a very, very small select type of commercial property. So we went from then basically being able to claim on the building structure, electrical wiring became part of the building structure, we were still able to claim on carpets, and then all of a sudden, there was a massive reduction in the amount of depreciation that could be claimed because the building structure depreciation rate effectively became zero. So it created a massive amount of confusion in the market. We were confused, but accountants were confused, investors were confused. So we saw really, I guess, a reaction from accountants where a lot of them said, look, you just can't claim depreciation anymore, which is just wrong, flat out wrong. I don't blame accountants. You know, the industry and field of accounting is massive. So for an accountant to know everything is impossible. And we work very closely with a lot of accountants, but you know, those that didn't have the likes of us in their ear telling them what you can and can't do, a lot of them just said, look, there's no more depreciation. So it sort of became a common misconception in the market, really. And that's what we've been dealing with since 2011. So it's been a hell of a ride over the last 20 years.
And so just to clarify, and so if you're a first-time investor listening to this, and depreciation is a foreign term to you, essentially, it's the ability to take an asset and say, okay, it's going to wear out over time. It's got a lifespan, 5, 10, 20 years, and allows you to take that asset, value that asset, and say, okay, it's worth $1,000, and each year I'm going to write up $100 in anticipation that eventually it's going to wear out. It's going to wear out. I'm going to need to spend $1,000 to replace it. So even though that doesn't wear out every year, you're allowed to claim a deduction against an expense for cash that you haven't spent on that year. It's a provision for replacing it in the future, just like businesses have provisions for bad debts and other things that they take into account where the future liability is going to require them to spend the money to replace it down the track. So it's a provision for things that are expected to wear out. So from a sensibility point of view, we all know carpets wear out, dishwashers wear out, washing machines wear out. And so we talk about depreciation, it's simply a provision for an expected replacement of the asset at some point.
Look, exactly right. And what ID have said is that, you know, owning an investment property or owning a commercial property or owning property in general that you're creating income off is like any other business. And, you know, any business is allowed or entitled or expected to claim depreciation against the assets that they own. So it's nothing new. It's nothing unusual. It's just simply good common business practice that at the end of the day, you need to maintain your asset, and depreciation is about providing you the income to maintain the asset. You know, in an ideal world, as an investor, you'd take all your depreciation and you'd stick it in a separate bank account, and then as you need to maintain the property, you'd pull that money out and you'd use that. But look, let's face it, that's the ideal world, but no one ever does that, not even in business, because you've got costs in business and you're reinvesting in other assets, etc. So what happens is investors will generally use that cash flow advantage or that tax advantage, and they'll use that in other forms or other areas of the investment. But again, they know that come the day they've got to replace the carpet, then they've got a cost associated with it.
Yeah, cool.
Yeah. So it's just good practice. It's good business sense, you know.
Yeah, and part of the challenge was the perception that investors are making money out of capital gains, not spending the cash on refurbishing properties. We've got an older aging stock of property in New Zealand. Not all of it healthy, not all of it well maintained. New Zealand landlords aren't always the greatest at maintaining the asset. Like a commercial landlord or a business owner normally would. Residential landlords have been a little bit more stingy around that, so that hasn't helped the perception. And so if we fast forward to today, Steve, and in 2020, and your business has evolved from a significant focus on reports for secondhand stock, changes in the regime which have reduced some of those benefits, but then we've had this massive growth in investors buying new real estate because of the healthy reasons and the maintenance reasons, and interest rates make it possible, and smaller land sizes and so on and so forth. Tell me how those two things work in 2020 from your business's point of view, and then the typical advantages on second-hand stock versus new stock from an investing point of view. Yeah,
so look, I'm a big believer that, you know, although I work in the area of depreciation and educate a lot of people, I'm a big believer that you know, depreciation is an added bonus, and it's not something you should necessarily be buying property based on.
Yeah.
But it can be a contributing factor, and where that can make a difference is buying older stock versus new stock. So, you know, depreciation is an allowance for wear and tear. That's what it is. So if you're buying a new property, then the wear and tear hasn't happened yet. So let's use carpets as an example. If the cost to replace the carpets in a house is let's say $20,000, in a new house, they're still worth $20,000. In a second-hand house, those carpets might be 10 years old, and they might be worth only $5,000 when you buy the house. So you instantly have a different starting base for your depreciation. On a second-hand property, your starting base for carpets might be $5,000. On your new property, your starting base for carpets is up at the $20,000.
Yeah.
So once you apply the depreciation to it, let's just say 40% for ease of terms and reference. So you got $20,000 of carpets, depreciation on that at 40%, then you've got $8,000 in depreciation just on the carpets in the first year. Whereas on the second-hand property, $5,000 worth of carpets, you've got $400 worth of depreciation in the first year on those carpets. So it makes quite a difference.
Yeah.
And really what that...
So when we talk about the $8,000, just to put that in, what does that mean in financial terms? It means that on the other side of the ledger, if you've made an $8,000 pre-tax, pre-depreciation profit because your income's exceeded all your cost by $8,000, the $8,000 in depreciation is a deductible expense that, married up with that profit, wipes out any tax liability obligation on that $8,000 profit. So if your marginal tax rate's 30%, now you've just saved yourself $2,400 in tax in that 1 year, just on that one depreciation item.
Yeah, exactly right. And look, I think really where people need to understand is the difference between positive cash flow and negative cash flow, and positively or negatively geared. And it's that word geared that's the absolute key. And really, positive cash flow is all about having a property that you've got your income coming in and you've got your normal expenses, your rates and insurance and interest, etc. And that's your cash flow at the end of it. So positive cash flow, you might be getting rent of say $10,000, you've got expenses of $5,000, so therefore your positive cash flow is $5,000. The geared aspect is coming in after taking into account things like depreciation and tax benefits and that sort of thing. So you may have had a $5,000 positive cash flow, but then you take into account, say, $8,000 of depreciation, which is a non-cash expense. You're not physically forking out that $8,000. It's just an allowance. It's a taxation benefit. So you then, from your $5,000 positive cash flow, you take your $8,000 in depreciation. You've now got negative gearing happening, and you've got a $3,000 loss, or it's negatively geared. And negatively gearing is okay because it's all about the taxation side and all those sorts of things. So depreciation is all about cash flow. The government has made some changes and rules around that cash flow because it used to be that you could apply it to your personal income, for instance. But what they've done now is those losses will sit with the property. Yeah. So if you've got a negatively geared property, we used that example, $3,000 negatively geared. So there's a tax loss sitting there. That tax loss now sits with the property, as opposed to you being able to take it and apply it against your personal income. So you used to get access to those losses instantly, but they now sit with the property until the property is well, in our example, it was positive cash flow. So it just uses up those gains or those profits as you own the property.
Yeah, and Campbell talks about it being a compulsory savings scheme in the sense that instead of taking that $2,400 loss, the $2,400 tax rebate, reducing my own personal tax that year and getting a tax refund, they stay with the property. Yeah. So instead of, say, paying tax by year 5, I might not pay tax until year 10 because my losses will carry forward, offset future profits, and eventually when those marry up, because depreciation's dropped to a certain point and rents have increased, then maybe I start paying tax at year 8 or year 10 on that property as opposed to in year 2 or 3 because I'm just sucking up the losses as I go as personal tax.
Exactly, because let's face it, if we get to use the losses now or we get a payout, we probably go on holiday with them.
That's right.
Rather than actually using them. So that's a great way of looking at it. And obviously with lower interest rates at the moment, all those sorts of things, we're going to be making profits a lot quicker.
Yeah.
or our profits are going to increase quicker, and therefore those tax losses just sit there and get used up as they need to. Yeah,
Yeah. So
it's not a bad thing,
no.
it's not a bad thing. Although although you don't see it on your pocket straight away, it sits against the property, which is great.
Yeah, and it means you've got increased cash flow in the future, which is probably at the time you're going to need to start replacing some of these things.
Exactly.
So I think the whole regime of Facebook and people taking selfies while they're on holiday in Fiji and saying I'm a property investor probably didn't help the perception that investors are extremely on the property.
I think there's a lot of conceptions or misconceptions out there about investors, but at the end of the day, investors have generally got other income and other business interests and everything else, and it's those things that have allowed them to do all right in life.
Yeah.
And property becomes a part of their legacy really going forward, not the be all and end all and the absolute main income and all that. There's very few people out there that are full-time investors that are making mega bucks. Most are not in that case, in that situation.
Yeah, 99% of our clients have got a 55 to 65-year-old horizon in mind, with providing income in retirement and choices of family options. And I've yet to meet one that's driving a Ferrari today, or has any plans to drive a Ferrari. And Campbell talked to this really cool old guy the other day, who's in his 60s. He drives a bus for $28,000 a year because he loves people. He owns a $9 million portfolio. Even though he's got an amazing rent base, he carries on doing what he loves because he doesn't care about the salary. So, retirement, even retirement, right? Who's going to sit on the couch and watch sitcoms or reality TV once you can afford to?
Yeah, look, there's a fine line between being a property investor and having a business that provides rental accommodation. It's a very different thing, and so many investors get caught up on wanting to have this massive portfolio and everything else. You've got to stop and understand, well, that's their business. So is it an investment or is it a business?
Yeah, absolutely. So what I might do, so actually before I do it, do you want to just explain from a Valuit point of view, do you want to just explain the key services you provide around the existing property depreciation schedule, the new property depreciation schedule, and for some of our listeners and investors who are watching this, we've got commercial as well. So do you want to just explain those and how that works?
Yeah, look, I'll sort of explain our report first of all and how it differs or what it's all about. So, depreciation is based on what you pay at the end of the day. So it has to reflect the dollar value that you can prove that you've paid for the property. So I'll explain that a little bit more later on and why I stress that. But at the end of the day, we're not providing you with a market assessment. We're not telling you what the property's worth. We're just simply breaking down what you've paid for the property. So that's the first major point of difference on what we do versus what a traditional land and buildings or registered valuer does. They're telling you what they think you should pay for it or what it's worth. We're telling you this is the breakdown of what you've paid. So we take the purchase price. The report will then be split into a land component. It'll be split into a building structure component, and then we list out all of the items that can be depreciated. So in a standard residential property, that's things like carpets, curtains, blinds, stoves, light fittings, light shades, heat pumps, fences, driveways, mailboxes, letterboxes. I just said letterboxes or mailboxes twice. TV aerials, smoke alarms, burglar alarms, motors for roller doors. You name it, it can all depreciate, and every item has a different depreciation rate. So what our report does is it lists everything out. It puts a dollar amount on those items, which is your opening book value from an accounting perspective, and it also lists the depreciation rates. So basically that just gets handed to your accountant if you're using one, or it's pretty easy to incorporate that depreciation into your tax return. And really it is as simple as that. Differences between new property and older properties, really nothing. You've still got a purchase price. The only difference really will be that some of the values on the things like carpets or heat pumps will be slightly lower because they're older. So really there's no difference. When you get into things like apartments, there'll be a difference, because often there's things like common areas in apartments. So, if you've got a high-rise apartment, there might be gyms, there might be, there'll be carpets and light fittings and sprinkler systems on each floor. So all those common areas can also be included. And then obviously we have to work out what percentage of those you're entitled to. So there's a few differences and things like that, but most of the time the reports look the same. At the end of the day, they always match what you've paid for the property. It's not terribly confusing. We always try and get in and do the property inspection once you've settled. And the reason we do that is just so that our report doesn't get confused with being a registered valuation for finance purposes. The last thing we want is that to happen. So, our report is just simply a breakdown of your purchase price.
Okay, so a couple of things I just want to touch on. So if I buy a 50-year-old property for $500,000 versus a brand new property for $500,000, what's my likely book value going to be? Like ballpark in terms of, just to give you the differences in chattels between a brand new versus something that's 50 years old, assuming there's been no renovations and updates.
Man, you've just put me on the spot, Dave. Yeah, look, on a new property, it might be that there's $60,000 to $70,000 of depreciable items, right? Yeah. So that's things like carpets and curtains and those sorts of things. On a newer property, on an older property, the new cost of those will still be 50, but it might be coming in at $15,000.
Yeah.
So there is a huge difference when it comes to depreciation. And, depreciation on new property is awesome. It really is. And it's far better than it is on secondhand property. Yeah. And, if you're paying, at the end of the day, you'd probably end up paying the same amount for the new property and the second-hand property anyway. Yeah. But what you'll find is there'll be an increased value in the land or the building structure, which is non-depreciable. So at the end of the day, you've probably paid the same price, but you'll find that your split or the apportionment across all the different items, there'll be a higher value in land or building structure, which is non-depreciable. Yeah.
Okay, and just the other thing I wanted to touch on is, and those that are business people will understand, but you start off with an asset ledger, essentially, that your accountant sets up with those opening book values, and the accounting system automatically drops them by a percentage every year. Yep. What should you do if you take something and destroy it, write it off, throw it away and replace it before the end of its life? Because depreciation is not just about what you do once, right?
Yeah, exactly. So, let's go back to carpets. I don't know why I always use carpets. It's just easy. Everyone understands carpets. But at the end of the day, if you decide to replace the carpets in your property, earlier we said the secondhand carpets when you bought it were $5,000. Let's say a few years later, you've claimed depreciation. They're now down to $1,000 in the asset register or in your books. And you decide, right, we're going to replace the carpets. We're going to spend $15,000, replace the carpets. That's not repairs and maintenance. That doesn't fit the definition or the areas that you have to qualify for it to be repairs and maintenance. It would be a capital improvement. So look, at the end of the day, without getting into all the technical aspects, your carpets are in the books at $1,000. You write them off, you dispose of them, you get an instant loss of the $1,000, and then your new carpets, which have cost $15,000, they go into your books at $15,000, and you claim depreciation on them going forward. And we used the example before of 40%. So you've got $15,000 of carpets, depreciation at 40% per annum. So that's it basically. But it's really important to remember that if you're disposing of an asset, then you're entitled to write off the residual value of that item. So if it still sits in your accounting register or your asset register with a small value against it, and you dispose of it, then if you're throwing it out, you can write it off. If you sell it, and let's use your carpets as the example, they're written down to $1,000. Someone gives you $500 for the carpets, then in theory you should be recording the $500 as income, and it'll be a $500 loss on the carpets.
Yeah.
So you'll get an extra write-off of $500 in that instance. So it's an extra $500 of non-cash expense.
Yeah. So keep records when you throw stuff out. Tell your accountant. Make sure you get receipts when you replace or buy new stuff to replace it with. Unless it's just a no-brainer, it's $1,000 on Trade Me, and instead of paying 10 grand, it's just worth the paying cash for near you or whatever. But keep your records, because all these things help you maximize. Ultimately, they reduce your tax, maximize your cash flow. So you're nuts not to keep records, and keep your accountant doesn't know, or she doesn't know, so keep them updated.
Exactly right. Yeah.
Thank you. So what I wanted to do is just to quickly jump across to this property investment analysis example, which I hope you can see on your screen, Steve.
Yeah, I can see that.
Your eyesight still good enough? You can see it without glasses.
I'm not that old yet, mate.
And I just wanted to use a real life example, because often when we're thinking about, we hear theoretical stuff as investors, we kind of think that's good, but I don't really understand how that applies in reality. So what I've done is I've taken this property here. It's a brand new one bedroom townhouse, unfurnished, and we've said, okay, it's got $20,000 a year coming in rental income. It's got some annual expenses. It's got some income before interest costs. After interest costs, it's got positive cash of $57 a week, or $2,944 a year. Or in this case, because we've got chattel estimation on this property of $26,000 in total, we can write off $4,700.25 in a non-cash deduction, but taxable deduction in that first year. So from the IRD's point of view, even though we've made a $2,900 profit, we've actually made an almost $1,800 loss. So to just bring this down to this example, and we talk about this $375,000 townhouse, what is it in that $26,000? In this example, that turns that into the book value that gives us that $4,700 deduction in year one, and $3,000 in year three, and $2,000 in year five, and these losses that then carry forwards until we make profits.
Yeah. So of that, if we look at the 375 purchase price, then what we are required to do for IRD is to say, okay, well, of that 375, how much of it is land? And let's just say that for ease of reference, let's say $200,000 is land, which leaves $175,000 for improvements on the property. And then of that, we'll be saying that, again, let's say 150 is building structure, which leaves 25, or in your case, 26,250, as the fit out and chattels that can be depreciated at the higher rates. So that will include things like your carpets, curtains, stove, heat pumps if they're in there, smoke detectors, fencing, driveways, all sorts of stuff, aerials, all those sorts of things. And look, it used to be easy. We used to say to people, just look around the house, and if it's not one of the four walls or the roof, then it can be depreciated. It is a little bit different now, because obviously things like the electrical wiring, etc., form part of the building structure. But that 26,250 is made up of, your traditional chattels, but then there's also some other things in there which can be included, such as your things like fencing and stuff like that, if it's a traditional residential property with a section, etc. So what you can see here is in year one, the depreciation is $4,725, and it's slightly less next year, $3,100. So it actually reduces. And the reason it reduces is that we use what we call a diminishing value rate. There's two rates we can use. One is diminishing value and one is straight line. And most accountants will utilize the diminishing value because it gives higher depreciation in the early years of ownership. So as you can see there, 4,700, and the second year down to 3,100, etc. So that gives you higher write-offs in the early years of ownership. And that's traditionally when investors need that cash flow a little bit more. What we are starting to see is, with the introduction of the likes of those losses being held against the property, I strongly believe more and more people will consider using straight line depreciation. And what straight line does is it applies the same amount of depreciation every year. So the 4,725 that we've talked about, reducing to 3,100, reducing to 2,100, that amount would be the same across every year of ownership of the property. And that might be at around the let's say $2,000 mark every year. So it just means it's the same amount every year. It really comes down to accountants. Traditionally, when the losses in a rental property could be applied to personal income, they've traditionally used diminishing value, but it will be very interesting in the next few years to see if accountants start to change what rates they use, whether it's diminishing or straight line.
Yeah, that's a good point. And in this example, because the property is so profitable pre-tax, even with depreciation, by the time you get to year 3, you're starting to pay tax even with the depreciation. So,
exactly.
But I always say, I think Bob Jones always said, no one ever went broke by making a profit. So it's not a bad outcome. And just to clarify, and I might not have explained that, Steve, but this is a 1, 3, 5, 7, 10-year forecast. We don't put all the columns in.
Yep.
Just referencing year 3, it's year 2, it's year 3, etc. But that's all, the principle's the same.
I did think the figures were dropping a little bit too soon, but it's all right.
We find that investors get square eyes if there's too many columns in a spreadsheet. So, okay, cool. Well, thanks for explaining that, because that helps people understand how that brings it into reality and what that really means. So let's talk about we've purchased a property, whether it's existing or new, we've settled it. Again, at what stage do we commission a depreciation report, and when does it need to be done by, from a taxation year point of view, to start claiming those benefits in the first year of ownership?
Yeah, look, the best thing is to get us in as close to settlement date as possible, but we generally try and go in after settlement. So it just becomes, at the end of the day, we become part of your discussion around settling on the property. It's nice to get in immediately after settlement if possible. Because generally there's no tenants in there and we've just got free reign of the property. But in saying that, we don't have to. I mean, 99% of the properties we go in are tenanted. Most of the properties have been owned for a period of time. And it's just really when people have got around to it. But the ideal, our report is a breakdown of your purchase price as at the date of settlement. Yeah. So anything that we do is as at the date of settlement. So it's best to get in to the property as close to settlement date as possible. And also, especially if anyone on a second-hand property is looking to make changes. Yeah. Because if they're looking to refit it and do all those sorts of things, it's really important that we're seeing the property in the state that it was. You know, we don't want to see the new carpets. We can't do anything with the new carpets. They're included by your accountant, or if you're doing your own accounts, they're included at purchase price. But what you will have missed out on is that write-off of that existing value of those carpets that you've paid for. So it's really important that, you know, we get in as early as possible on any property transaction, but it's not critical.
No, and the key is what you're doing is you get to the place and start disposing of and demolishing stuff and throwing it away before the chattel portionment's been done. You're just literally throwing away hundreds, if not thousands of dollars of tax you'll actually have to pay as a result unnecessarily. So that's the reality when how does it affect your back pocket. So in terms of, if someone's listening to this or watching this and they go, yep, I've just bought property, I realise I've never depreciated it. But if I bought it 3 years ago, is it too late to get you into an apportionment?
No, not always. It really just comes down to having a chat and talking things through. And then we can make an assessment, and, you know, accountants probably need to be involved if you're using them and all those sorts of things, but we can handle all that. That's what we know. So we know that the questions to ask, and obviously then what needs to be discussed with accountants and all those sorts of things. Yeah.
And so to find out more, valuit.co.nz.
Yeah, just remember, Valuit doesn't have an E. It's Valuit, not Valueit. So Valuit. Don't ask me why, it's a long story. But yeah,
www. Like Google, right? You're cool like Google, you just want a made-up word like Sony and Google and Nike. Everyone
yeah, let's go with that. And then also on our website, there's actually some examples on there, but there's actually a calculator as well, where it works for residential property. You can put some information in there and it gives you an idea as to the potential levels of depreciation that you could be expecting. Yeah.
Yeah, and that's great as well. And it's one of the simplest things you can do in the sense that if you get this right, you spend $400 on a report and you get literally thousands of dollars worth of tax savings, particularly over the first 5 to 7 years, or deferred tax. Just by doing this, it's just a return on investment equation, and you're a no-brainer. It's a no-brainer to do it, and you're missing out on a lot by just not doing what exists within the tax system. It's like paying your employees' wages in the business by cash, as opposed to making them a deductible expense for your business. You'll just pay tax on that money. It's nuts to not do it.
Yeah, we don't have too many upset clients, mate.
That's great. Well, is there anything else you want to touch on, Steve, before we wrap up? This has been really insightful, and I think it's really helped to really break this down to the simple steps and simple reasons why this all makes sense.
Yeah, look, at the end of the day, I think, as an investor, just keep it simple. Understand that depreciation's there. Understand that you're really obligated by IRD to claim it unless you declare it. You have to formally declare it as a non-depreciating asset if you're not going to do it. But I really struggle with people that don't do it. I really question why, because it's just about paying less tax and having more money in your pocket at the end of the day. Some people get caught up around what they call depreciation recovery or clawback tax. If you start to hear those sorts of things mentioned, please just back away. When it comes to residential property, especially nowadays, it's completely irrelevant. Do carpets wear out over time? Yes, they do. So depreciation recovery or clawback is all about the fact that they haven't depreciated. Well, it used to be a bit of an issue with buildings, but on residential property now, it's pretty clean cut. It's pretty clear. Things like carpets, things like stoves, things like light shades, they clearly go down in value. So depreciation occurs. It's just purely about giving you that cash flow to maintain the property.
Yeah, and if you don't, you're shortchanging yourself of the cash you will need in future as capital to replace those items when they do wear out. So
yeah. I really struggle with people that don't claim it. It's just like, why the hell wouldn't you? I really struggle. Yeah.
So, well, that's great, Steve. Well, I mean, your business now is 22 years old.
I feel old, man. I feel old.
Give me 1 second. To my knowledge, you've always been the only true specialist, in that you're solely focused on this in New Zealand, and you've been the market leader from the get-go, really, because there was nobody else specialising. So, in terms of expertise, I mean, you led the charge in terms of consulting to the IRD with all of their policy decisions and all the reforms they made on behalf of investors. So there's no better.
Not too much. Let's not hype that up too much. But definitely worked with IRD along the way and talked with them, and they understand who we are. We've even had them refer a job to us in the recent past, which is pretty impressive. But look, at the end of the day, we're the only company that specialises in it in the country. It is a specialist area. You've just got to know it. So, I always say anyone can increase your depreciation, but the key is to maximize it. And that's what we're all about.
Yeah. And as I know over the years, your biggest challenge has actually been educating accountants so that they can get it right for their clients.
Yeah. Look, and I don't have an issue with accountants not knowing it. They can't know everything, but as long as they listen and, talk with us and take what we've got to say on board. So, yeah.
And just another tool in your toolbox in terms of team of specialists, Valuit, and the valuation and estimation of chattels and apportionment of chattels should be a critical part of what you do, along with an accountant, mortgage broker.
Mate, we're one of the goodies because we make you money rather than cost you money. Yeah,
that's right. That's right. So that's cool. That's awesome, Steve. Thanks. We'll wrap it up there, and obviously share this with the team. Thanks for putting aside the time and sharing your expertise, and look forward to catching up with you again, and maybe for a bit of an update from you on the market and your views on the property market under a different topic. But not today,
mate. I tell you, there's some interesting stuff out there at the moment, and watch this space. I think with investment going forward. So, yeah,
that's awesome. Cool.
All right, Dave, thank you very much. Always happy to talk. I'm not sure if you noticed that I'm a talker, but no, always happy. And to people watching, good luck with your property investments. It's awesome. And take care.